We're here for a debate on a topic that's been generating quite a bit of headlines over the past few weeks, thanks to the publication of Michael Lewis's new book, Flash Boys. So we're here to talk about high-frequency trading, what it is exactly, why it matters, and where it's headed. So I'm joined by two very accomplished and very opinionated capital market participants, although neither, for the record, are high-frequency traders. So to my right is Jim McCaughan, who is CEO of Principal Global Investors, which is a global asset management firm. He's had a long career in finance and investment management, holding senior positions at Credit Suisse, Oppenheimer Capital, and UBS. He also has the distinction of having joined us as a panelist for the last 11 years at the Global Conference. So thank you, Jim, for being here.
Thank you.
To my left is Rishi Narang, who is founding principal of T2AM, which is an asset management firm focused on quantitative and short-term trading approaches. He's also co-head of asset management for TradeWorks, which is a quantitative hedge fund manager. So we're going to jump right in, and I want to start with Jim, since you're the skeptic on the panel here, I guess, with a brief definition of what high-frequency trading is.
Gosh, Katie, how much time have we got?
Brief.
Brief. I'll try and give a brief description and context, but I would caution you that fiendishly complicated does not do justice for how the equity trading system in the US has developed. Not necessarily bad, just complex, with a lot of people doing different things. The way it got that way is really through two waves of re-regulation, deregulation. The first was commonly known as decimalization, which led to the change from, previous to decimalization, a price would be quoted as 20 to 2025. After decimalization, you could quote 20 to 2001. So it narrowed down the quoted spreads, which really was the encouragement to algorithmic traders and to the use of IT systems to do faster and more automated matching of trades. So that was one wave, and that was really what led to the start of this phenomenon. And that was in the late 90s, really. And then 2005, the SEC introduced something called Reg NMS, Regulation National Market System. That was implemented in 2007, and what that did was introduce competing trading venues. In other words, you have a proliferation of exchanges, you also have providers of dark liquidity, the so-called dark pools, and that led then to a bit of an arms race in terms of making things faster, making things work in a more automated way. And the real boom years of high-frequency trading, when they were most profitable, was a year or two after Reg NMS was implemented. So 2009 through about 2012 were the peak years for volume and profitability for HFT. Since then, competition has made it more difficult for them to make money. So what actually is HFT against that background? And against the background where what used to be done on the floor and on the telephone by traders is now mostly done by linked computers using very fancy, very fast telecoms. High-frequency trading, I would define as being any approach to trading which aims to add value by very rapid-fire execution. And characteristic of high-frequency trading, therefore, is a very large number of orders automatically executed, a lot of order cancellation, because there's a lot of testing of the market. So there's a lot of orders which are put out there and cancelled in a fraction of a second. And when I say a lot, I mean thousands, often in one batch. So there's a lot of rapid-fire movement, a lot of order cancellation, and that leads to a lot of complexity. And I have a position on this. I did 4 years ago describe some high-frequency traders as structured front-running schemes on CNBC. I think that was a real minority view then. I think most people believe that now that at least some of them are, and that the way they front-run is by using different ways of finding out what the information is about what market participants are doing. We can talk about this a bit more later. But not all high-frequency trader is front-running, and a lot of it is about trying to anticipate market ticks on the very low level and takes small profits. And in some cases that adds liquidity, in some it takes it away. But it's just the rapid fire computer trading is really what these high frequency trading funds do.
Okay, so that's great. I want to come back to your perspective on speed and how that's impacting all of this. But Rishi, if you could just respond and give us your thoughts on how you would define it.
Sure, yeah. So I think the primary clarification or adjustment I would make to Jim's definition of high frequency trading is I don't think it has as much to do with rapid fire trading as it does to trading which is sensitive to how quickly you can access markets and how quickly you can access data about what's going on in markets. And I'll give you an example. One of the most famous HFT trades is called index arb, right? And index arb is about finding two instruments that are effectively identical, fungible in some cases, trading in different venues, like the S&P futures in Chicago and the S&P ETF in New York. And when you see that they're not priced exactly the same, then it's free money to sort of to make that arbitrage trade. Those trades are often held for a pretty long time because you can't afford to exit quickly. You actually have to wait until there's a way to exit at mid or even at the passive side of the order book. So you can actually see index arb guys hold positions for a long, long time, but they're very, very sensitive to getting into that trade very quickly and to knowing that that arbitrage exists very, very quickly in real time, because otherwise other people will find out that there's free money on the street and they'll rush to pick it up ahead of time. So just sort of low latency sensitivity is primarily my adjustment to Jim's definition. And then I'll expand on it by sort of saying that I think if we want kind of a taxonomy, there are probably, depending on how you want to slice and dice it, 3 or 4 types of HFTs. There are a couple of types of market makers who truly do provide liquidity. They place passive orders in the lit exchanges in the order books. They internalize order flow from brokers, like we heard yesterday. TD Ameritrade routes orders out to some of these liquidity providers. And then, so that's one type, is kind of market makers, and you could kind of boil them down to the contractual kinds like internalizers and the more voluntary kinds that participate in the lit exchanges. The second major category is arbitrageurs. I've already given an example of what sorts of things they do, but they're generally looking at structural relationships between instruments that have to be similar, and when they're priced in a dissimilar way or move in a dissimilar way, then they arbitrage that difference. It's not quite free money, but the goal is for there to be some free money there. And then the last category is what I call fast alpha. These are people who are really just trying to make the same sorts of timing decisions that any other active investor makes. Is this stock a good buy or a bad buy right now? A good sell or a bad sell right now? And they're just doing that at a pace that's quicker than the average investor.
Okay, great. So let's pick up on that topic of speed, because that, the desire for speed advantage, obviously, in trading is not a new phenomenon. But Jim, I know you think there's more at stake here. So can you sort of parse it out for us and explain what it is about high frequency trading you object to?
Yes, or at least about some.
Some of it.
And Rishi's comment about index arb is absolutely correct. That is one of the high frequency things that happens. So I don't think the definition, there's much between us. I actually think we both have, although we're neither of us high frequency traders, we both have a pretty good idea of the taxonomy going on. When Rishi discusses low latency, that means fast. And fast, I actually think, is better than slow. However, when you talk about a really fast trade, what you're talking about is being able to do things multiple times a second, not taking a few seconds over it, which is probably how people still think about stock exchange trading. Most people probably still think about, if they think about online, they think about somebody somewhere doing a phone call to execute. Well, that's not how it works anymore. And actually, your trade can be fully executed in a very small fraction of a second. I don't think that's a bad thing. I don't think it's crucial for most investors who are thinking of holding a stock for months or years. But I do think that many of the opponents of high-frequency trading are essentially Luddite and saying pace is bad, competition is bad, we don't like Reg NMS. I'm emphatically not on that side. I think pace is good. I think efficiency and automation is good. I think that Reg NMS bringing in competition was almost entirely a good thing, although I think Rishi may disagree with some aspects of that. But we'll see. I do think that, therefore, when people say, and many of you probably went to the trading panel yesterday, when you hear people in the retail market say, retail investors have never had it so good, I don't know what the fuss is about, that may be true that they've never had it better in terms of execution of trades, both pace and cost. However, when industries automate, use greater speed, use more automation for efficiency, usually a lot of the benefit gets through to the end customer. My belief is that because of some weaknesses in the market conduct rules, that speed and efficiency have not benefited the end user, the end customer of the market as much as hopefully they will in future. And I think what's needed to make that happen is to go with the speed of trading. We need different market conduct rules. And I think that's essentially what I would suggest should be the agenda going forward for regulators. Just to close on this topic of pace, I actually really enjoyed reading Michael Lewis's book. I think the sort of novel bit of it, the descriptive bit of it, is about 80% accurate, which I think is not bad for something as fiendishly complicated. I actually totally disagree with two of his conclusions. Firstly, the market is not rigged. I think it's clunky, it's more expensive than it needs to be, it doesn't always match buyers and sellers as efficiently as it could, but price discovery works, and price manipulation, which is implied by the word rigged, isn't really the problem. I think also it won't fix itself through market means alone. I do believe it needs new market conduct rules, which in effect probably have to be regulations from the SEC. So those are some of my comments on speed.
Okay, so we'll talk about regulation as we move on and what both of you think in terms of what should be done. But Jim's point about speed not benefiting the end user, I imagine, Rishi, you have something to say about that.
Yeah, so I would like to hear maybe a little later from Jim in what way he can measure, right, the attribution of benefit of speed to HFTs versus to the end investor. But maybe if we could pull up slide 12, what you'll see on this chart is that according to the Tab Group, which is an independent research company, HFT profits for the full year 2013 are estimated around $1.1 billion. Now, that's not a small number, right? But it's also not a big number when you consider that this is the aggregate profitability of all of the liquidity provision, arbitrage, fast alpha, and if there is any bad behavior, it's in there too, okay? All of it put together is $1 billion. Now, when you think about the face value of all trades for the year, this adds up to less than 0.1%. So that's a pretty crappy profit margin, right?
It was better at one stage.
It was, yeah. I mean, you can see in 2009 and even 2010, it was better, but it's fairly quickly dropped off, right?
And that's competition.
That's definitely competition.
Yeah.
It's competition, it's regulators getting smarter, it's some of the rules improving, it's volatility coming down. It's a variety of factors that drive this. This isn't just to say, poor HFTs. I mean,
so in 2010, when I shocked Andrew Ross Sorkin, I might have been right, even on your numbers.
Well, it's hard to say whether 4 billion is, or 7 billion or 6 billion is a fair number or not a fair number. It's really hard to say, right? Because even then, volumes were higher, and actually in 2010, TradeWorks estimated that the profitability of HFT was right about where it is today. For a good HFT, you make about 0.1 cents a share for all the stuff that you do, right? 0.1 cents per share. We're not talking about, and by the way, this isn't to say that if that is ill-gotten, that I'm okay with 0.1 cents a share. It's just A, we're talking about 0.1 cents a share, and B, I happen to think that almost none of it's ill-gotten.
But what about the criticism that high-frequency traders are gaining an edge by being able to process market-moving information ahead of other people?
They are, probably, in almost all cases, and that's totally fair in my opinion. So there's this very...
Can I chip in on that one with a quote from actually Rishi's firm? I think it's a really good one, actually, which I would totally agree with, if you'll pardon me for reading it. This is an extract from TradeWorks' submission to the SEC in 2010. And there's just three bullet points I'll read here. Using publicly available data more intelligently than your competitors is a fair practice, even if the goal is to predict their behavior. Totally agree with that. Second point, jumping ahead of an order that was placed earlier, and earlier, remember, might be like a microsecond ahead, but placed earlier at the same price by another trader is an unfair practice because it undermines the principle of price-time priority on which our equity markets are premised. Unfortunately, this unfair practice is widespread. Remember, this was 2010, is widespread due to deficiencies in Reg NMS.
Yep.
I actually think that's a very fair statement and one that points to the need for a reform agenda.
Yeah, there's one really specific reform. I'm going to get into some slightly more maybe inflammatory statements in a minute, but while we're on the while we're on the agreeing part, I might as well just go down that path for a minute longer. The biggest reform that is needed to eliminate most of the funky order types and this appearance of front running, and in some cases, it's not actually fair to say it violates time priority, but it is fair to say that it looks really, really bad, is an end on the ban on locked markets, right? This is a really specific point in Reg NMS. The idea of a locked market is you can't have resting orders at the same price on both sides of the book. So if the bid is 10 and the offer is 11, that's not a locked market. If the bid is 11 and the offer is 11 and they're not interacting with each other, meaning that the trade didn't happen at 11, that can't happen, right? Because of that and the fact that the central processor, which gives data to most participants, is pretty slow and it's not good technology, and there was no incentive to make it good technology. Those two things taken together have led to this gigantic proliferation of order types to get around this ban on locked markets, which is totally arbitrary. If we like penny spreads, why don't we like zero penny spreads, right? So stupid. And really, really simple. And actually, it's not totally an accident that the ban on locked markets is in the regs, but it's also largely an accident. It's pretty much an arbitrary, it was more or less a coin toss, right? And I've heard this from people who were involved in the decision, right, directly. So this is, I'm not going to name names, but okay. So look, I think overall in markets, there's a very arbitrary dislike of short-term trading, and it's not just the markets, right? Like my fund, it gets taxed at the ordinary income rate, right? Jim's fund probably gets taxed at long-term capital gains. Yep. Now, why? That's pretty lame, in my opinion, right? I'm on the ass end of that deal, so I guess that's why I don't like it. But
hey, and my investors are giving long-term risk capital to business.
Yeah. Yep.
So maybe the different tax isn't so bad.
Well, but they're only doing that because they can transact in the markets, which are only like they are because they're liquid.
They need the markets.
And by the way, what in the secondary markets, none of that money is going to those companies. It's going between buyers and sellers, right? So actually, if we could pull up slide 10, and I'm not going to read this slide to you. You can read it while it's up there, but in my head, I was going to read this out loud and get up and talk to my chair like Clint Eastwood did. I really was going to do that.
Yeah. I should move away.
I think it's the best slide I've got, so you can take your time reading that while I'm yammering. Yeah, look, I think in general, all active investing is about anticipating the behavior of others, all of it. There is nothing other than that. So when Warren Buffett buys a stock with a 3-year time horizon or whatever, he's only buying it because he thinks it's going to go up, right? There's no altruism here. He's not putting people to work by buying shares of Goldman Sachs in 2008 on some sweetheart deal. He's buying it because he thinks it's a good deal, right? And it's a good deal because he thinks it's going to go up later. Well, why will it go up later? It'll go up later because other people are going to buy it, right? Well, that's the same thing as what almost everyone means when they say front running at HFT. It's order anticipation, just on a slower, longer term and aggregate scale. Really no different in my mind. Entirely arbitrary to say that doing it at the millisecond level is bad, but doing it at the 1-year level is good. I mean, so what's the cutoff for a good socially functioning or social high utility time horizon? It's just so weird to me that people freak out about time.
Jim?
Index arbitrage fits the description you've just described, Rishi. The problem I have with some of the practices here is that we now have a dozen stock exchanges, not one.
Yep.
There are variable levels of price and transaction reporting. We know that there are payments made for people to have access to information from what's happening in those exchanges in real time. The problem that I have with this is, yes, if it's based on anticipating without knowing what the investor's going to do, but if what's happening, and I do believe this happens in different ways, is that an investor gives an order, maybe parcels it out between multiple exchanges or does a bit in the first place. It's not too difficult then for the trader's algorithms to say, hey, there's a buyer in the market, let's buy in front of them. And that's triggered by the investor's own action. To my mind, that's fraudulent conduct because it's based on what the investor is doing within the exchange and doing with people who owe an obligation of care to the investor. So the information's leaking out.
Actually, I have a few problems with the statements you've just made. First off, there's one kind of HFT that has this fiduciary responsibility with orders, and that's the internalizers,
yeah.
right? And as you'll see later, my opinion, and not all of the HFTs in this room are going to like what I'm about to say, I don't really believe in internalization. I also don't believe in dark pools. I think that all the stuff should be on the exchanges. Right? We'll talk about that in a minute. But,
yeah, we will.
But, so I don't mean to digress into that just now. I just want to say that an HFT who trades on the lit exchanges has no obligation and knows nothing about your order until it's on the exchange. Now, the fact that he may see it on the tape faster than you see it on the tape is entirely normal. In fact, I would like to look at slide 4, please. So here's kind of a timeline of what happens, right? An order hits the market in reality. The order hits the market at time 0. About a half of a millisecond later, or a microsecond later, a direct feed
really
user.
Quick.
Yeah, a direct feed user will know it. 1 millisecond after that, roughly, a professional trader who gets the level 1 price feed off the SIP, which is that slow thing I talked about earlier, that's how slow it is. It's about 1 millisecond on average. Now, the average doesn't tell you everything. In really busy times, it's even slower than that. 20 minutes later, my mom finds out about that price. 20 minutes later, because she doesn't want to pay $2,000 a year for real-time data. Now, why in the hell are we okay with 20-minute delays? And why aren't we calling that front-running, right, by Jim of my mom? Right? If I'm front-running Jim with 1 millisecond. I just don't, to me, it's the same exact thing. It's the event happens in the market. I invested $1 million a year or $200,000 a year, depending on how you want to parse it, to find out that it happened on the market, and then I'm reacting to it.
Yeah, one of the issues with that, Rishi, is that your mom, who I hope is an investor, will be doing it through a financial advisor or an intermediary, so she'll be at the SIP user point, not 20 minutes later.
No, when she decides what to do, she's looking at Yahoo Finance.
Yeah, sure, but the execution will be by some intermediary.
But her decision is based on old data.
Yeah, that's true.
And your decision is based on less old data.
Yeah,
and
but
some high frequency.
But the execution is by a professional, so she can't be front run is really the point. Because the professional should be sophisticated enough to avoid, or at least that should be the case.
The reality is also that they are, though. Something like 98%, we heard yesterday, of all orders come from co-located servers.
Yes,
so,
no, that's true. And a lot of those are investors like your mom who then come through intermediaries.
That's right.
But they can still be front run in that 1 microsecond between, because if you've got an order and it gets placed with, say, 2 of our 12 exchanges, and then a direct feed user on one of the exchanges finds it out. It so happens there's more latency to the other exchange. Then the direct feed user can front run the second half of the transaction. And that's using information that still belongs to the investor.
How does he know that there's a second half?
Well, that's law of large numbers. He'll do it multiple times.
Then he should do it every time there's any order. Then it's a stupid trade. No one would do that. Well, they'll go out of business.
I don't think that's true, because I do believe that there are variable latency arbitrages which are being used to front run, and your chart actually shows the very short period, the microsecond, in which it's being used.
And isn't part of the criticism too what's happening to these orders that they're actually getting canceled and not going through?
Yeah, so that's a different criticism that people have. Cancellation of orders is a thorny subject. I'll point out a couple things, and I'm going to rely on data here from the Securities and Exchange Commission, who have become very, very sophisticated. In fact, it's going to be slide number 11, please. So the average resting time for a quote, and I apologize, this is a pretty busy graph, but the dark blue bars on the left of each section of bars are full cancels, and the light blue or turquoise bars, the third ones in, are full trades. Okay, so there's partial cancels and partial trades too, but what this is showing you is that at different slices of time, at different lifespans, right, how long do orders last, and how long did an order last before it was hit and became a trade? And what we see is a very close relationship at almost every time scale between the ability of an investor to hit an order and the ability of a market maker or HFT to cancel that order. So if the turquoise and the dark blue lines are relatively similar, then it means that everyone's pretty fast. That's basically what this tells you, and this is also the interpretation that the SEC takes. So the other point in this chart is that the average resting time is around 2 to 3 seconds for an order. It's not a microsecond like you'll hear in the press. It's not a millisecond. It's 3 seconds, right? It's about the same as it ever was.
Yeah, but those full cancels at the very short durations, at the very short lifetimes, are primarily, I would suggest, from traders who are using pinging to find other people's activity. I would guess they are.
That's a guess. Another, by Occam's razor, perhaps more likely guess is that when you are taking the other side of someone else's trade, there are a lot of pretty smart investors, and if they're willing to cross the bid-offer spread and take your liquidity, you have to be a little bit worried, right, about just sitting on the other side of that trade. And if you find out that your order, you placed an order to buy at 10, some other HFT beat you to it, and now you're not near the top of the queue, you're somewhere in the middle of the queue or the bottom of the queue, you may cancel just because it's really terrible to sit down there. We estimated that there's about a 2-cent difference in profitability, a minus 2-cent difference, being last in the book versus being first in the book. And remember that being first in the book averages around 0.1 cents a share.
Is this current data, Rishi? Is this?
Yeah, this is, it's from their data highlight in March 19th of this year.
Yeah, I was trying to read at the bottom.
Yeah, I apologize, it's a tiny.
So one of the things that I think comes out in the data is that there was a lot more rapid fire trading. There was a bigger profit in high frequency trading 2 or 3 years ago. I think you'd find that left-hand blue line was much bigger relatively back then before the competition straightened things out. I think also that one of the problems I have with the rapid fire cancellation is there is a cost for exchanges and other investors, both in terms of messaging and in terms of instability in very rapid fire trading. And that cost is socialized. So HFTs are aiming to make money in a sense at the expense of the exchanges and other investors. And I think there is some that's one of the reasons why I do believe that some restraint on rapid fire order cancellation would be a positive thing. A number of things have been discussed, some of which would be very clunky. Messaging charges is one thing that's been discussed. Trading at rests, trading only once a second rather than continuously. That might appeal to some people in the digital era. I'm actually not sure that either of those is really the right answer. I think a bit of a consultation period is needed. But I would like to see that rapid fire socialized cost borne more effectively by the people who are incurring it.
Exchanges are actually pretty well, exchanges are actually pretty well suited and have already begun to do this. There are at least 2 or 3 of the lit exchanges that have begun to penalize excessive cancellations. But what's really good about this, and I want to be really clear and on the record as much as I can be, I'm not against regulation. I think it's humans need to be told what to do. Okay, we're willing to sell our kids into slavery if we're not told that it's illegal, right? I mean, we believe some really crappy things. So I'm actually a pretty lefty sort of a guy, but I just want smart regulation. And a smart regulation here is to let it be market driven, right? Yeah. Because if one exchange has superior tech to another exchange, why should I impose some artificial structure on that difference, right? I should rather say, okay, well, if he can handle 1 billion messages a second and he can handle 1 million messages a second, that's the market. And so let him penalize for excessive cancellations, and maybe he doesn't need to.
Yeah.
Okay. I want to come back to the issue of instability and what this may or may not be doing to the markets. But a few minutes ago, you were both talking about the contribution your businesses are making to investors. And one of the things that high-frequency traders say, or people who are in support of it say, is it's lowering transaction costs, it's creating a lot of liquidity in the markets that has broad-based positive effects. So Jim, what would your response be to that?
Well, firstly, I would completely agree that things that have happened in the last 15 years or so have lowered costs, and I would highlight, as I did at the beginning, decimalization and Reg NMS, the competition it brought in. I think that has been a positive factor for how markets operate and how they discharge their how they fulfill their potential to improve the economy, which I think is really, really important. Market-based economies work better than anything else. I do think that however, that this is a very important agenda from the point of view of maintaining that confidence. To my mind, and I think many people in the room will probably agree, the best way to allocate capital in an economy is through a competitive market. So the more efficient the competitive market can be, the better. I'd like slide 1, please, this is an extract. Slide 1 is an extract from a report we just produced or just sponsored, written by an academic group in London who polled investors worldwide. And this is institutional investors, retail platforms, about developments in the stock market and how they affect efficiency and how they affect the effectiveness of stock markets at doing what they need to do. And what I would point out here is there's almost as much red for high-frequency trading as there is for insider trading. Now, insider trading, I think we'd all agree, is a crime, and people do go to jail for it. I think even the good high-frequency traders, the ones who are providing liquidity and helping the market, and those people exist, I think they have a problem here, which can only be dealt with by greater transparency about the way the market operates, and therefore greater confidence. Which is why something Rishi said that I totally agree with is that we need new market conduct rules. I happen to believe that some of that will come from the exchanges and from competition. I think some of it has to come from the regulators, and some of that will be reducing the issues like the contingent trades that Rishi mentioned. Some of those are totally crazy, the order trades. I would actually try to do something about order cancellation for the reasons I mentioned earlier. I think a major abuse is the payment for retail order flow. I think when anyone is placing an order on behalf of a customer, when an intermediary is placing an order on behalf of a customer, they do and they should owe a duty of care to that customer, which means they have to act in that customer's interest. To have a choice of trading venues, some of which pay for the order flow and some of which don't, is basically an intolerable conflict of interest. So I think the payment for retail order flow and the so-called maker-taker practices are something I would like to see regulation outlaw. Now, I'm not a regulation enthusiast either, but I do believe that competitive markets with a lot of smart people trying to make money, with both positive and negative sum games going on, they need rules of market conduct. And market participants, since markets were invented, have depended on having solid rules of market conduct. I think what's going on here is we need the types of reforms that Nishi was talking about and I was talking about, but we need to make sure that those reforms catch up with the technological development of the market. And my contention is they haven't yet. And I think that's what the perceptions from investors tend to support.
Okay, Rishi, I want to give you a chance to respond and comment on that. But another piece I just want to inject in here, because I think it's important to talk about in the context of all of this, when you're talking about proprietary information, is dark pools and the trading that's happening inside of there. It's not transparent. It's not particularly well overseen. I mean, people would say that. So can you talk a bit about that, and you can respond first to Jim's point.
Yeah, so I want to reference one thing on Jim's slide. This was number 1, I think, whatever it was. Yeah. Okay. So I'm going to come back to this, but I just want you to notice the very top bar is the proliferation of off-exchange trading avenues, which are essentially dark pools and internalizers, primarily dark pools. And they're viewed as even worse than HFTs. So I'm going to come back to this in a second. I could also just quickly and cynically say that transparency is part of it. I agree completely. But another part of it is just propaganda, right? And HFTs, until pretty recently, have been worse at propaganda. They've had less interest in doing it. And so the information's been really, really one-sided. There are some really vocal, kind of stupid people who say a lot of stuff that is factually wrong, like logically impossible statements that are just, in the press all the time because they're the only ones willing to talk. So anyway, I'd like to look at slide 13 really quickly. I'm not going to dwell on this too long because my central point on HFT is not that it adds liquidity, it's not that it reduces volatility. Those are both true statements. However, I don't care. Right? I believe in sort of a free country, and as long as it's not hurting in aggregate, those who are bad actors should be punished. Full stop. Mostly there aren't bad actors. Mostly things are fine. And to the extent that mostly things are fine, then leave it the hell alone. Like, why are we, when do we get to decide what's good and bad? Why do we have Coca-Cola and candy bars, but we don't want high frequency? I mean, it's so weird to me. But, here we have some numbers, right? So intraday volatility is volatility that happens from the open of the market till the close of the market. And that's when HFTs are active. I think we all agree HFT is not really active overnight when the markets are closed. Overnight volatility then is primarily driven by news, right? Fed speaks, there's earnings, there's all kinds of stuff. So we'll call that macro volatility, and we'll call the intraday volatility micro volatility. So critics of HFT will say, well, look, volatility's gone up 9% before and after HFT. Okay, I would say that we've also had a financial crisis in there that may be a confounding factor for that 9%. So let's try to break it out. Let's look at overnight volatility and intraday volatility. And what we see is that the median move in the S&P is 41% larger since the advent of NMS and HFT. The overnight move is 41% larger than it was before. So yeah, volatility overnight has picked up a lot, and that clearly explains most of the change. In fact, all of it, because open to close volatility, intraday volatility is basically unchanged. High-low volatility is another way of measuring this, also unchanged. I mean, it's up 3%. When you look at it relative to macro volatility, it's actually gone way down. Well, this doesn't necessarily answer the question about, well, there are more extreme instances, there are more flash crashes. Actually, there aren't. There aren't more flash crashes. There was a flash crash in May of 1962. I think we all agree that wasn't due to HFT. There was another in May of 2010, and they looked almost identical. So what, right? There's one in each era, right, before and after. It's not a big sample from which to draw conclusions. Right. But what we also see is that the frequency of large moves, which you can measure empirically, yes, there are more large moves intraday, but nothing like what you see overnight.
Yeah, I think that evidence is ambiguous, though, because the earlier period includes the 2000 to 2006 period, which Alan Greenspan rightly described as the Great Moderation, when everything was really stable temporarily. I'd regard that as a very anomalous period. Now is more normal, actually. And I think there are good fundamental reasons why the volatilities change.
So let's shift quickly, because I want to...
I'm telling you, though, that we've done this analysis with a whole bunch of time scales, and you're welcome to do it. I downloaded this data off Yahoo, as you'll see on the bottom.
Yeah, I think there's always different ways of interpreting it, but anyway.
In general, overnight vol has, unless you want to pick 2 days, right? Overnight vol has gone up a lot, and intraday vol hasn't. Like, you can look at this just looking at 07, 08, 09. You won't get any difference.
Yes.
Okay. So let's shift a little bit. Because whatever you think of high-frequency trading, it's by most estimates represents over 50% of all equity trades in the market. So it seems the genie's out of the bottle, so to speak. So I want to make sure we have a little bit of time for questions. But before we open it up, let's talk a bit about what's been going on in the regulatory space, in the legal space. There was a lawsuit in Rhode Island recently. I think it was the city of Providence is suing Bank of America and, related to these practices. We've talked about the SEC, the Justice Department looking at this. So, Jim, can you start and tell us where you think we're headed?
I think actually the legal cases might give us some information about the debate Rishi and I are having about how many bad actors there are. I suspect if there are as many bad actors in HFT as I suspect, then we're going to see some results from these legal actions. And if Rishi's right, probably not. So I actually rather welcome them, because they'll give us more clarity, I hope, about what's going on in the world.
Rishi, what are your thoughts?
AI never welcome lawsuit.
No,
Providence
you wouldn't. That's true.
Providence
but-
is literally suing something like 20 or 30 or maybe even 40 firms. It's not just B of A. They're suing virtually every bank. They're suing brokerages. I think Ameritrade was named. They're suing every HFT that they've read about in the news.
No, I was referring more to the regulatory investigation.
If we could pull up 16, and I agree with you entirely, that I'm a huge believer that insider deals need to be prosecuted, as you'll see here, number 6. So Jim and I think, talked a little bit about this before and agree on most all of these things. There's one where we will strenuously disagree. So I've already mentioned getting rid of the ban on locked markets. That's pretty uncontroversial. Zero spreads are good. It gets rid of tons of all the need for all these weird order types. So that simplifies the market and it makes it more rational. That seems like a win and a win, right? Secondly, I think it makes sense to even the playing field by making the SIP as fast as getting direct feeds.
Yeah, and that has the same effect as something I've said, which is to
Banning
put
colo.
restraints on co-location and direct access. If the SIP were speeded up to be equivalent to the direct feeds, that would be an unnecessary move.
Right,
so I would support that for that
and
reason.
I would say this is even better than getting rid of colo, because if you get rid of colo, then the next nearest data center becomes the new colo. That's an endless spiral. It doesn't help. So I also believe in getting rid of payment for order flow. Now, I will tell you that even though this is something I believe fully, the evidence is actually ambiguous on this. There are pretty good studies that have said that overall, all things included, the cost to a retail trader of making a trade has come down, and that one of the drivers of commissions coming down is that brokers are now able to make money this backward way. The reason I still support getting rid of these payments is because why have all this complexity? I mentioned Occam's razor earlier. I'm a big believer in simplicity, and maybe it's because I'm too dumb to keep complicated things together, but I just don't see that we need it, right? So fine, have a $12 or $15 commission, but no payment for order flow, and let's just make it like that, right? This is the one where I'm pretty sure we disagree. I think that if you have exchange-traded instruments, they should trade on exchanges. And in all exchanges outside of equities, that's the way it is. There aren't dark pools for options. There aren't dark pools for futures. So we have exchanges. We have like 12 or 13 of them now. Let's use them, right?
Yeah. My counter to that, if I may, if you don't mind, as we go through those, in terms of dark pools, it's a terrible name. It sounds really sinister.
Not to me. I've mentioned my favorite color is black.
Well, that's good, actually. I kind of like black as well. I'm wearing a black suit. But,
mine's blue. But
Anyway, it's the heroes of Michael Lewis's books, IEX, are technically a dark pool.
Yeah. So ironic.
Which is kind of ironic. They're technically a dark pool. Dark pools vary a lot. The dark pools are dark in the sense that they're private venues for doing transactions without all the exchange reporting requirements. And like all major institutions, in the last 5 years particularly, we've put a lot of effort into tactics in terms of exposing our orders to dark pools or to exchanges, and trading cost analytics. And we use that to decide which dark pools we're going to operate through and which we won't. That analytics is a guide to action. And what that tells me, since there is a variation here, is different dark pools have different rules in terms of who sees the information, who can light them up in a sense. And I think that's the real abuse, not the existence of dark pools.
Okay.
I would actually suggest that dark pools probably should continue, because I think I tend to go with markets and with market solutions where possible. I tend to think they should continue, but I would like to see some kind of rules around who can switch on the lights and who can't.
So the reason I disagree is not because I think that they're all homogenous at all. They are heterogeneous, and some are better than others for the investor. The reason that I don't like them is, well, and it's ironic also, right? You like transparency, except for when it comes to your orders, right? And I don't mean that in a pejorative way. Of course, that's what you want.
Of course you do. Of course you do.
And you want to take advantage of that
the
capacity.
The order that an active manager puts into an exchange is their own intellectual property, which someone else should no more be able to steal than they can breach a patent.
Okay, that's fair. On the other hand, if you trade badly, you will
Correct.
always, and throughout history, you will
Correct.
always have gotten picked off.
Correct.
It's got
And
nothing to do with computers. And
That's why we have to be really sophisticated, just like all the other funds do.
In general, again, if you look at other markets, CME futures, you can't trade CME futures anywhere but the CME. Costs have gone down there too, funny enough, right? So if we're starting to try to think about what can we attribute reductions in cost, reductions in volatility to, I mean, the proliferation of exchanges might be a reason, the proliferation of dark pools might be a reason, but they also might be the reason that we had the flash crash, right? So, I mean, I think we have to be very, very careful with this multiplication of entities that don't have the same sorts of, and by the way, you want to talk about tiered systems and insider clubs. Dark pools are operated by firms that get to choose who participates in them. So if I want to participate, right, in a dark pool, I might not be allowed. I got to go ask permission, and Goldman Sachs is probably going to tell me no, because they're Goldman. They tell everybody no.
They've still got a big dark pool.
They've got a great big dark pool, and there's a great chance that their internal prop traders are on the other side of your trades in there, right? Which is why that's more comforting.
Okay, we're getting down towards the end. I was told we could go a minute over too. Just so much to talk about here. If I want to make it open to questions, if we can maybe take one or two questions, if there's anyone in the audience who has a burning question. We have microphones going around. Just put up your hand and the microphone will come.
We've answered everything.
Oh, Steve? Oh. There's a micro. We'll come to you second, and then Steve Wynn first, please.
Listening to this conversation between Jim and Rush, listening to that conversation is probably the most pristine example of the agility of high-frequency traders and the rationale for it. I live in a regulated business with a very volatile stock, and I know that because I've been in a public company since I was 25 years old, that the whole principle of trading is that no one is supposed to have an advantage on private information when a trade is made. The entire structure of the high-frequency trading, everything about it was to gain an advantage, a piece of inside information, whether you bought the stream of orders from Goldman Sachs or Citicorp, or whether you managed to get your microwave transmitter quicker than the fiber optic cable. The whole idea was to sell something that you knew someone wanted quicker than they were able to do it in a normal way. I listened very carefully to this exchange this morning, and I've been impressed with the intelligence of both sides. But Jim, I'm on your side.
Thank you,
anybody
Steve.
that's trading is on your side. And you can rationalize Michael Lewis all you want, but he nailed this process cold. He nailed it, and I don't think you guys are going to talk your way out of it. We need regulation, and it's going to be a real challenge for what is basically a dumb government to catch up with the intelligence of the guys that are doing this. And I hope they do.
So, Steve, I, with all respect, disagree with almost every single thing you just said. Not surprising. I'm sure that will not have surprised anyone in the room. Look, I've already said I agree that we need regulation, right? I've even given some very specific examples of what I think we need, which Jim has agreed with. So if you agree with Jim, then you kind of agree with me too on all but the dark pools thing, which I'll be interested to hear what you think about dark pools. The reality is that speed has always been an advantage. The company Reuters exists because they had a carrier pigeon network in the 1800s. Rothschild Bank made an absolute fortune shorting French government bonds because they found out, again via carrier pigeons, that Napoleon had lost Waterloo. Speed's always been an advantage. There's a reason that the Wall Street address matters, right? It's because for a long time it did matter. That was the center.
But even in the age of the carrier pigeon, market conduct rules were needed, and that's no less true now.
We aren't disagreeing.
Which is why, thank you for your support, Steve, and appreciate it. I do really believe that the way to move this forward is not actually that different between Rishi and I, because it's about market conduct that catches up.
Are you trading with IX?
Yes.
IEX?
Yes.
Me too.
Yeah.
So
I'd like to list my company on IEX.
Yeah, they don't think, as a dark pool, they can't do listings yet, but they may move that way because
they're planning to.
They'd have to become technically an exchange. And IEX is a brilliant technical idea, only time will tell whether they really clean up in terms of creating a demonstrably fair marketplace. But so far, so good. We do trade with them.
Okay, I think unfortunately we're so over time. We're going to have to close with that. If we've learned anything, it is that we need probably another 2 or 3 sessions on this, and certainly we'll continue the conversation. Thanks everybody for coming. Thank you very much, Rishi and Jim, for being here and providing perspective.